the self-sufficiency program, right? So we look at the rent for the property and we make sure that it can cover the mortgage. So it's a great program. Down payment requirements are going to be a little bit higher, but it's a great program for people that are investors that want to purchase the property.
What's up? Welcome to the Hube Knows Best Pod. I appreciate your support. In return, I hope I provide you with some worthwhile gems that benefit you on your journey. At the very least, I hope I put a smile on your face. If not, hopefully you share this with someone that does benefit. And I got you next time. Again, thanks for joining today, and let's get this thing going. All right, welcome to another episode of the Hube Knows Best Pod. You can be anywhere in the world, but you're here with me, so I appreciate y'all. On this pod, I plan to give you the truth, the whole truth, nothing but the truth, well, as best as I can. So help me God. So I'm your host, Hube Smith. Today we'll be diving back into the world of loans, rates, and everything that makes lenders tick. This is the second part of a two-part series on how to get the best lending options for your home, whether it be residential, like single family, or multifamily, meaning multiple units. So I want y'all to get ready for some tips and valuable insights from a great guest we have today, Mr. Terrell of Molitar Financial Group. Terrence is the VP of lending there. He's here to add information that we got last week and help shed some light on all the aspects of lending, and good, bad, or indifferent. So welcome, Terrence.
Thank you for having me. I'm looking forward to contributing and adding and helping as many people as possible get into homes, because it's a beautiful thing.
So Terrence, before we get going, give the audience a little bit of your background so they know just, how dope you are as a person.
So I've been in residential financing for the last 5 years. Prior to that, I was a personal trainer for many, many years. The transition was smooth and seamless. It's a very different industry, but the idea and concepts behind both are the same. I meet many individuals and they come to me with goals and aspirations, and I help them get there. Same thing with personal training, as I've applied into real estate. So I enjoy helping people achieve goals. It's what I do.
It's interesting how you and my past guest, Janita Herndon, ended up in your roles. She started off at Victoria's Secret as a manager. So both of you guys don't come from finance backgrounds or things like that, but to end up where you are, that's super dope. Let's jump right in. When you're thinking about this as a individual that's looking to purchase property, whether it be, like I said, whether it be a single family home or multi-unit property, what are some things that people should be doing or they should take? What steps should they be taking before reaching out to a lender?
I mean, realistically, I'd say the first thing they should do is reach out to a lender, because what I see a lot is, and think about it from, my analogy is always car sales. People always go to a lot, look at cars, they're online looking at cars. They do the same thing for homes. Look at homes, go to open houses before they figure out what all their numbers look like. Having that initial call with the lender up front is the first thing someone wants to do. A few things that someone can do even before placing that call is know what their personal numbers are. And what I mean by those is their comfort level when it comes to where they want their monthly payment. For the most part, people are paying rent, unless it's their first place, they may be living at home, whatever the situation may be, but they kind of know what they're comfortable paying monthly. And our job is to make numbers match. We want to make sure that the number that you give is both comfortable, but also realistic. Someone tells me they want their monthly mortgage payment to be $1,000. Depending on what they're putting down, we're probably not looking at $500,000 homes. So we want to make those numbers make sense. So that's what we do when we're qualifying somebody. But, you kind of want to have that general idea. Some people want to, are comfortable paying a couple of bucks more than they're paying in rent for a mortgage because you own it. You're building equity. So those numbers may be a little bit different. But then also the second number is going to be comfort level when it comes to cash on hand. How much are you comfortable parting ways with and then coming out with a home? If you have X number of dollars saved up, we probably don't want to use all of it. After you buy a home, everything then falls on you. You want to make sure you have something saved and put away for a rainy day. Those are the things that we want to know. Okay, I have X saved, but I'm comfortable using this much of it. Those are the things that you're going to want to know in that initial call. But other than that, have that first phone call before you start looking at homes.
That's definitely an interesting perspective. I think I did it both ways. I looked at homes and then said, okay, this is how much money I'm willing to spend, or this is how much of the loan I want to do. And then other times I was like, let me see how much I can get pre-approved. It's definitely a way of thinking and different approach that can save you some of a headache. Yeah. So I definitely understand.
Absolutely.
Different lenders, you work for a mortgage brokerage, right? And my last guest worked for a bank. So from your perspective, what are the 5 things that you guys are working for from the mortgage brokerage side? They
should be about the same, because when originating mortgages, a conforming loan, it's going to have to fit certain guidelines. Right. Those guidelines are set forth by, Fannie Mae, Freddie Mac. So the things that we look for should be the same. We look at income, employment, right? So the biggest thing we want to look at or find out is, does someone have the ability to repay? That's thing number one. If you don't have the ability to repay, yeah, well, so that's fair enough. Do you have income, usable income? That's also something that we want to make sure that we can take a look at, because we need to look at employment history. So depending on how you're paid, that's going to determine whether or not we can use the income. You are a full-time salaried employee, we use your full-time salaried amount. If you're a part-time employee, we average it. We need a 2-year history of it. You work full-time or you just got a part-time job, which is great. You can use that income. You can count that in your expenses and your calculations, but you just got a part-time job because it's going to help out a couple weeks ago. We can't use that income. That's what I mean by usable income. Someone that is self-employed, 2-year history,
right?
Because there are a lot of entrepreneurs out there, people that start their own businesses and they do well, which is great. But we need to make sure that that's going to continue. That's what, the guidelines are looking for. They want to make sure that this income is going to continue. So it's averaged over 2 years.
Yeah, that makes sense. I'm in sales. And so like the 2 times I bought property, I'm on commission. So they're like, okay, so what's your average over the last 2 years? I'm like, it's going
right.
Like I promoted at that time. The first time I bought a house, I had just gotten promoted like a month before that. So the income that I was bringing in was like going to be vastly different year. I definitely understand that. All right. So that's the usable income. Income is clearly important, right? You got to be able to pay.
Another thing we look at is credit score. Credit score is going to determine several things. It's going to determine your interest rate.
Well,
it's going to determine how high we can take your debt to income ratio, which is something, another thing we'll talk about. It's going to help determine if you're, putting down less than 20%, it's going to help determine your mortgage insurance. Credit score is important. All these things kind of lead into what I said previously is have the conversation with the lender first. As soon as you're thinking, I need to buy a home, make that call. One thing that a lot of people don't think about is, can I source where the funds came from? Every dollar that's used in a purchase transaction has to be sourced. Mm-hmm. So, if you have some money laying around the house and you're depositing it into your bank account, we need to know where it came from, if it's a sizable amount. Because what we look for is large deposits. We're looking at FHA financing. They have a 1% rule.
Mm-hmm.
So if it exceeds 1%, if the deposit amount exceeds 1% of that price, that's a large deposit. We have to source it. That's why I'm having this conversation early, because we need to know, okay, are there deposits on here that we need to source? Do we need to, if funds need to season it for a while before we can use them? Are we going to be, because what we look at a 2-month history of bank statements. That's something that we look at that a lot of people don't think about. They just figure, oh yeah, here's some cash. I got, some money from a family friend or somebody paying me some money back. We need to know where it came from.
I had to have my mom write me a gift letter on the first house just because she gave me some money towards the house. And I was like, they were like, well, no, you gotta have her write a letter saying this is a gift that you don't got to pay back. And I was like, okay, I guess. It's my mom.
Yep.
Live in the house, but okay.
Exactly. So, and everything has to fit in a box.
Right.
Has to pass those guidelines, it has to pass the SNP test. Another thing would be a co-signer, co-bar, multiple people in the finance. If there are multiple people in the financing, because this is something that people always ask about, if their credit score may be a little bit lower, or if they need some help with income. Can I add someone else onto the financing? Yes, but there's a couple things that some people don't know when adding someone else. They're a full-on borrower on your loan. It's not someone that's just, passively on it where they have no responsibility for it. We're fully qualifying them as well. They're on the loan. Even if they're a non-occupied co-borrower, we qualify them. Same standards apply. Credit, income. We look at debt to income ratio. And when there's multiple people in the financing, we will use the lower of the 2 credits.
Yeah, I didn't even know that.
Yeah, that's one thing that a lot of people didn't know, So I get asked that question a lot. My mom or my friend or, my spouse, my partner, they have higher credit score. Let's add them on. It'll help. I'm like, well, we can use their income. Yes. But we will still use the lower of the 2 scores.
Which makes sense. I mean, you're not going to put someone on there with a worse credit score than you, right? But you're the person that's paying. So we need to know what's going on with you, right? So yeah, it makes sense.
That's about it. I mean, like I said, ability to be paid, credit score, debt to income. Did I talk about debt to income?
You mentioned it. We didn't really.
Well, let's talk about it. All right. So let's talk about it. So debt to income. That is, your monthly obligation versus your monthly income. When qualifying, and this is how, people say, how much am I pre-approved for? This is how we figure that out. We pre-approve you for a monthly payment. And then from that monthly payment, we work backwards to figure out a purchase price. But we need to make sure that, and this number is going to depend on credit score, it's going to depend on the program, but we need to make sure that your debt to income ratio, your monthly obligations, meaning minimum credit card payments, car payments, student loan payments, plus your housing payment, doesn't exceed about 47% of your monthly income. Depends on the program, depends on the credit score, but that's going to be about an average. I mean, conventional financing, we can potentially take it up to 49%, FHA probably up to about 55%, but it depends. Everybody's situation is different.
This is just something from my own experience. Make sure if you're going to pay debt down, that you pay down the debt that is actually affecting you the most. So like you can ask the lender or the bank, what monthly expenses do I have coming out that is really affecting that score? Because you might think paying off a certain amount might help you, and it won't. I take it from personal experience. Paying off the wrong,
absolutely,
reduce that number if it's not the number that they're saying is your largest monthly debt.
It's not necessarily that, it's not the total debt. Right. It's the monthly payment.
So I definitely appreciate that information. So taking it a step further, when you're, looking at lending from a bank versus someone like you guys, what's the real difference there? I know from my experience, like on this past home, I worked with two larger banks. One of those banks was not very local. So like there was a lot of red tape. There was a lot of things they weren't aware of. Whereas when I went through the local mortgage brokerage, they were aware of all the programs. They had different things that they were looking at. So could you kind of give us a little bit more detail on that?
The two big things are going to be products and specialization. Generally speaking, companies that specialize in only mortgages have access to multiple products, multiple programs, whereas someone that works with a bank has one set of products. People that work with brokerages and specialized standalone mortgage companies have access to different wholesale lenders, have access to their own lines of credit. So, we can have access to 10, 15 different lenders and products. Banks have one. If they're local, they know the area. They know what programs are available for, certain areas, certain income tracks, certain zip codes. A lot of lenders lend in multiple states. I do as well. But, those that specialize in certain areas are going to have the leg up because they know the ins and outs of the market. They know, and just like any industry, I don't want to call it a small community, but it's a tight community. So see the same names over and over. So you may have a competitive edge when it comes to having an offer accepted as well. I have had clients that have won offers, I'm not that big of a deal. I'm not anything special, but I've had clients that have won offers because of my name. I know the listing agent because I've worked with the listing agent. I've gone to networking events with the listing agent, or I've used, they networked with me somehow in the past. So a combination of myself and their buyer's agent being local, they say, great, okay, this is an offer coming from, Terrence and, so-and-so agent. We'll take this one over the other one because we know it's going to get done.
Yeah, I think the other thing is like understanding who your loan officer is that you're working with. Like in my most recent experience, my loan officer was actually like behind me as far as like time zone. So like that was throwing off communication and all this. And they had how you're supposed to communicate via like an email, like a online portal. And I was like, bro, just call them. Call me, send me a regular email. Like you're not responding. I don't know how many deals you're doing right now. Like this is not a great experience. And it's actually,
you want to work with someone that's available and helpful. Realistically, I mean, my clients text me.
This is actually one of my banks that I bank with. So it almost made me like close my bank account with them just because of that experience. It was like, this is ridiculous.
I get it.
All right, cool. So like kind of segueing into that, like I bank with multiple banks, but I also understand shopping for deals. Like I'm in software sales as my full-time job. So I have customers always trying to leverage this vendor is offering this and what have you, right? So like, what is your experience or like, what are your thoughts around people shopping for rates or even trying to get better rates than what they're initially offered?
That all comes back to the pre-approval process. That's when you do that. I fully expect people to have conversations with other lenders. I'm not the only one in the world. I do the best I can to earn their business, but I fully expect those conversations to be had. But you want to have those conversations at the time of pre-approval. You want to the lender that issues the pre-approval that you're submitting your offer with should be who you're working. It all depends on timing as well. I mean, I have people that have been looking for homes for months. That initial interest rate we talked about months ago is not going to be current. The big thing would be just have the conversation before you submit your offer. I do my pre-approvals property specific for that reason. We'll talk about, okay, you're qualified for X amount, go shopping. 3 months later, we've submitted a few offers. It's time to submit another one. I update the pre-approval with that property address, with where the current market is, because those change. Right. And we have the conversation. Based on the current market and your situation, here's where rates would be.
From a timing perspective, like if you only have like 30 to 60 days to close, like in my situation, I had like less than a month to close. So like I didn't have time to do all that. But like if somebody has months, things could have happened. You could have got laid off. Anything could have happened during that 2, 3, 4 month, 5 month period where you're shopping around.
Right. Exactly. So that's why we do them real time. Perks of having multiple investors and multiple lenders to work with and multiple products, I do most of the shopping anyway. So I look at who's going to do the best for their situation, and that's who's going to end up, that's who we're going to do their loan through.
I think we touched on this a little bit earlier, and I talked about it on my last episode. Like, could you go like in a little bit of detail as, the key differences between an FHA loan and a conventional? Kind of explain what FHA is, because I think people hear that name, they don't know what that really means. They might have certain perspectives or thoughts around what FHA really means about you if you're doing an FHA loan.
It's interesting. Yeah, sometimes, depending on who you talk to, FHA does have a negative connotation to it, but it's a product for a reason. It's offered for a reason. It helps people get in a home. Some of the biggest differences between conventional financing and FHA are going to be down payment requirements, credit score requirements. FHA will allow a lower credit for a property, for a purchase. FHA goes down to, I can do FHA down to 500. Minimum for conventional, 620. It all depends on, again, their situation. FHA below 580 requires a higher down payment, 10%. FHA 580 plus, you can do the minimum, which is 3.5.
Okay, so I didn't even know that.
So, those are going to be some of the differences, and another factor is going to be, if you're looking at the minimum down payment, again, FHA generally 3.5%. Conventional, if you're a first-time home buyer, you can put down 3%, depending on what the credit score is. That's going to determine and factor what your mortgage insurance is. So mortgage insurance is something that you pay to insure the loan if you have less than 20% equity in the property. With conventional financing, mortgage insurance is going to be determined based on your credit score and your down payment percentage. So the higher the score, the higher the down payment, the lower the mortgage insurance is. With FHA financing, your mortgage insurance factor is fixed. Okay. They have a fixed factor, 0.55%. So depending on what your credit score, what your down payment is, with conventional, your mortgage insurance could be much higher or could be much lower than that. So that's why we look at both. And it depends on what you're buying and how you're buying it too. There's plenty of advantages, FHA versus conventional.
For those that didn't watch the last episode, mortgage insurance that he's referring to is PMI. It'll show up as PMI if you didn't know. If you ever see that when you're looking at what's the document that you guys send out, the pre-approval letter or whatever, loan estimate, right? So you'll see a PMI number on there. So that's what PMI is, your property mortgage insurance. With it, I know with your conventional, if you don't, your PMI can actually go away if you pay the principal down to a certain amount. It'll go quicker, right? Mm-hmm. Is that the same thing with conventional? Do they have different rules on that?
Good question. Actually, with FHA, your mortgage insurance is, you put down less than 10%. Your mortgage insurance is for the life of the loan. That's big. But here's the thing, and here's the realism. Most people don't keep the same mortgage for 30 years. You need to take those things into consideration when you're buying the home. We look at the differences, and if you put down greater than 10% with an FHA, you keep it for 11 years. It goes away if, depending on the down payment. But that's why we need to evaluate what the difference is between the two with the interest rate, with the mortgage insurance, with the monthly payment, to see what's going to benefit you the most. Are you going to keep the loan for a while? Or do you plan to refinance it? Do you plan to sell the property? Those are the things we need to figure out when we go determining FHA versus conventional.
Speaking to the refinance and play into like buying other properties, selling other properties, one of the audience members asked me to ask this on the last episode, so I'm going to ask you as well. Like, What is really the difference between financing a single family home and a multifamily home?
It's going to be the income that we can use. It's going to be how we finance. It's going to be the down payment requirements. So with a multifamily, becoming a landlord, buying an investment property, we can use the projected rental income to help you qualify for the property. So you should qualify for a greater purchase price than you would if you were just buying a single family, because you're going to have investment, or you're going to have income coming in from the tenant. So, we look at, and that rental income that we can use is going to be based on the appraisal. The appraiser will tell us what the market rent is for that particular unit, and we could use 75% of that to help qualify. Okay. So that's going to be, that's going to be big. Down payment requirements are going to be different. So, going conventional financing, if you're buying a 2-unit, for example, your minimum down payment on that's going to be 15%. If you're buying a 3 to 4 unit, 20%. Now, depending on your income, there are programs available where you can put 5% down up to a 4-unit, but that's income dependent. So if someone makes less than 80% of the area median income, you can do 5% down up to a 4-unit.
Okay.
Just depends on where the property is. If you're going to find something, just a 3 or 4 unit, and still qualify for it. With FHA financing, you can do 3.5% down up to 4 units. That's a product that a lot of first-time home buyers that are buying multi-units, they go that way. They go FHA financing because they can put a little bit less down. Even if they have, phenomenal credit and they could do conventional, they may want to stay a little bit more cash liquid. So they'll put less down. They'll go FHA and buy a multi-unit.
Yeah.
Live in one, have the tenants help pay off the others. But one thing that is something that a lot of people do not know about is something called the self-sufficiency test. And this only applies to FHA, and it only applies to 3 to 4 unit properties. So if you're buying a 3 or a 4 unit property with FHA financing, it has to be self-sufficient. And what that means is based on the appraisal, like I told you with the appraisal, we look at those market rents. 75% of the total rental income for the building has to be able to cover the entire mortgage.
Yeah.
And that's self-sufficiency. That's something that a lot of people don't know about that comes into play. Only 3 to 4 units with FHA.
I mean, that's important information.
But it's a smart way to go.
There are 2 programs I wanted to ask you about, so maybe you can expound on. One is DCRS. Is it DCRS?
DSCR.
Yeah, that one, that loan. And then maybe NACA, the NACA programs.
DSCR, debt service coverage ratio, is a loan for investment. And it basically means that we qualify the property and not you. Along the same lines as the self-sufficiency program, right? So we look at the rent for the property and we make sure that it can cover the mortgage. So it's a great program. Down payment requirements are going to be a little bit higher, but it's a great program for people that are investors that want to purchase a property. But let's say, for example, if you're someone that's self-employed and you just started a new business, so your income doesn't support the purchase. You have the asset, you have the money to put down, you have a good credit. We can look at a DSCR because then you can purchase the property and qualify the property, not based on your income.
And then the NACA program, or first-time home buyers with all they really have is down payment. They have maybe not great credit.
The way that I explain some of those first-time home buyer programs is they're phenomenal programs to get someone in the home. The terms may not be the greatest, but it'll get you in a home.
Okay.
Because a lot of some people will qualify for a property, but don't have the assets to cover down payment.
Right.
All right. Some people, again, back to what we look at, debt to income ratio, right? So their monthly income supports it, but they don't have the assets to cover their down payment closing costs. So we can look at getting them into one of those first-time homebuyer programs that'll give them the money.
Okay.
But there's always a trade-off. There's always a trade-off. There is, people will argue and fight me on this all day, but there's no such thing as free money. So There's a reason why it's offered, because again, it's a good thing to get people into homes, but the trade-off there is most of the time it's going to be a higher interest rate.
Okay.
And there's going to be a repayment period. And each program is different, but basically what those repayment periods are, if you sell the home or change the financing within X number of years, 5, 7, 10 years, you have to pay back what was given to you upfront. Some of them have a restriction where you have to, if you're going to sell the home, you have to sell it to someone else that's using a similar type of program.
Okay.
So, those are the things, again, back to my very first point, have that initial phone call to find all these things out. Because again, like you said, everybody's situation is different.
Definitely.
So, one program may benefit you where it may not benefit me, or one program may benefit, somebody else, but it's terrible for someone else. So, it's not a one size fits all, but we want to make sure that we look at your situation. Okay, I have income, I have credit, I don't have assets. Or I don't have credit, but I have assets, but I don't have income. We got to figure out what that combination is. And, if it's not the right time to buy, we figure out to put a plan in place.
Okay.
Not everybody that has the goal of home buying can buy today. It may be tomorrow. We may have a few steps to take to get there.
Right.
That's why, starting early, having that initial conversation is key.
Anything like anecdotal or anything that you want to share with the audience before we wrap up here?
And not just because I do it, but I'd say the most important thing I can tell people is you get yourself a good, trustworthy loan officer that's going to help you achieve your goals. Go into the conversation with as much information as you can, but also an open mind. I am a huge proponent of I stay in my lane. So if I'm going to someone because they're an expert in the field, I defer to them. They know what they're doing. They're an expert in it. They know what they're talking about. I am not going to, come have a conversation with you and tell you that I know all about software sales. So I need you to do it this way. I have no idea what it's about. I can Google as much as I can, but you are the expert in the field.
Right.
You know what I mean? So that's one of my, biggest recommendations for people is make sure whom you're working with is trustworthy. Again, do your research, look at reviews, get a recommendation from your lender to a good real estate agent or vice versa. But just make sure that you're working with someone trustworthy that is looking out for your best interests and know that they're trying to help you and that, you may not be the expert in that field, in that situation. Let them help.
All right, man. Terrence, I want to thank you for coming on and sharing this information. I think it's very important for people that look like us, but just people in general, because this information isn't always readily available or people don't know where to go get it. So I think this is going to be very enlightening for some people, but also, just useful information as they're going through their process. That brings us to the end of the episode. This is another great episode of Hube Knows Best Pod. So like I said in part one, it can be scary. It can be serious. This is a very serious thing, but just enjoy the journey. Make sure you're prepared. Talk to the right people. Talk to multiple people to understand, but make the process, the purchasing journey, a joyful one. I want you guys to tune in to next week. We're going to have a very inspiring guest, my personal friend of mine, Casey Richardson of the Blaze Group LLC, and she'll be sharing her journey on entrepreneurship and knowledge on capital raising for startups and businesses. So as I continue to say, I encourage you to be your best self, be the best version of you, because everybody's already taken. I wish you peace, patience, understanding, knowledge, wisdom, discernment, health, strength, resolve. Till we meet again, take it easy or don't, but every action has a reaction and every choice for sure has consequence. Peace out.